What's up and welcome to Smart Money. In today's video, I'm going to talk about investing in index funds. I'm going to tell you about what an index fund is, how it differs from other securities, and whether or not you should buy them. Stay tuned. I have a friend, we'll call him David, who recently got into trading stocks on Robinhood. He's very excited about investing and he's looking for some strong companies to invest in. Like many people, David's first stocks are companies that his friends told him to buy. Companies like Uber, JetBlue, and a few others. I told him about my personal finance blog and YouTube channel, and he started asking me more questions about specific companies he can buy. Judging from the nature of these questions, I can tell that his view on the stock market needed some adjusting. Rather than write my friend a very long email that he probably wouldn't read, I decided to share what I'm about to say here with anyone else who might be new to the stock market. Judging from the nature of this channel, you should support us by clicking the like button for the YouTube algorithm. I'd really appreciate it. Clicking the like button is a great way to invest in the channel and to show your interest in personal finance. If you're new to the channel, or if you've been watching for a while, thanks for joining us. I'd like to see where our viewers are from. Comment your city and state and country in the comments section. David isn't the only person who's coming into the stock market right now. In fact, all the cool kids are doing it. It's said that 90% of people who make between $35,000 and $75,000 a year use their stimulus check to buy stock. CNBC.com cites Tobias Levkovich, Citi chief U.S. equity strategist, as he says many new investors see the current economic climate as a generational buying moment. Like people who are new to anything, these new investors require guidance so that they don't waste their hard-earned dollars buying stocks without proper planning and research. Based on David's questions, I observed that he seemed to view the stock market as a place where you can buy shares in a company, wait until the company makes a big move, and then sell your stock on the company when the share price goes up. While you can do that, it's an unideal way to build wealth. That type of mindset is in line with speculating in the stock market. I define speculating as attempting to make an educated guess on the stock's ability to increase in value when you buy it, with the intent to sell the stock in the near future, less than 2 years. Though I'm sure many people feel like they know a very successful speculator, most speculating has a high probability of failure. When new investors buy companies without a strategy with the intent to sell in the near future, they're speculating. Speculating isn't always bad, but it's not the best way to build a portfolio. In my opinion, the best thing new investors can do is learn an investment strategy before putting a dime into the stock market. My favorite investment strategy is called dollar cost averaging. It's fairly popular, uncomplicated, and a relatively low-stress way to invest. You research a few companies you might be interested in buying, and you purchase shares in those companies at regular intervals. Most people who use dollar cost averaging buy more shares in their chosen companies every time they get paid. What makes dollar cost averaging low stress is that you don't really need to concern yourself with how the stock is performing on a daily basis. You buy shares in the company whether the price of the shares go up or down at whatever your chosen time frame is. The intent behind the strategy is to hold your shares for many years. Many people buy shares on a continual basis and don't sell anything until they're ready to retire. This is ideal because it allows your money to grow through the power of compound interest. Despite the stock market's daily volatility, it tends to go up in value over the years. For example, in 2010, the Dow Jones Industrial Average, or DJIA, had an average closing price of 10,668.58 points, according to microtrends.net. The average closing price in 2020, despite the year's volatility, is 25,446.38 points. That's a 138% gain over the past 10 years. So $100 invested in the DJIA in 2010 would be worth $238 today. That's not to say that you could have invested $100 in any company in 2010 and that you would have $238 in 2020. You have to know which companies to buy. In order to pick companies that are likely to stand the test of time, it's wise to use Benjamin Graham's 7 value stock criteria described in his book, The Intelligent Investor. I'll go over Graham's 7 criteria if you guys express interest in learning them. Benjamin Graham is the man who taught Warren Buffett investing. Graham also said that if you are unable or unwilling to put in the work outlined in his 7 criteria, then investing in index funds is a good alternative. NerdWallet.com tells us that an investment fund, also known as an exchange-traded fund or ETF, is a type of mutual fund whose holdings match or track a particular market index. I prefer investing in index funds. I have a few individual stocks that I buy, but the majority of my portfolio is made up of index funds. Detractors will say that index funds may be low risk, but they're also low reward. That's true to an extent. People who invest in individual companies are often trying to build a portfolio that earns interest at a higher percentage than the stock market. People that invest in index funds are often just trying to match the stock market. I'll start with the bottom line up front. It's widely known that 90% of active fund managers have failed to meet or exceed the S&P 500 index for over 15 years. That may be the most attractive feature of investing in index funds. You match the market automatically with little effort. Another attractive feature is that index funds are passively managed. Companies are assembled in the fund at varying percentages, and then they're usually not adjusted again unless one of the companies is removed from the index. This enables index funds to carry low to no management fees. This is in stark contrast to mutual funds. Mutual funds are actively managed and usually charge fees of at least 1% whether they gain or lose value. Another benefit of index funds is diversification. Diversification allows an investor to reduce risk by owning stakes in multiple companies. It can be difficult and expensive to select multiple companies to invest in on your own. However, an individual index fund may hold dozens of companies at varying percentages, thereby reducing the risk of making a bad investment. I would warn that reducing risk through buying index funds does not mean that it's a risk-free investment vehicle. Investing tends to come with some level of risk. For example, when the bull market ended this year, my favorite index fund took a beating. It lost 2/3 of its value over the course of a month. But since I dollar cost average, I wasn't too worried about this. I viewed the market as being on sale and took opportunity to purchase more shares of my index funds. Remember, you lock in your losses when you sell if a stock is down. Index funds are generally easy to invest in. They're traded like a stock and can be found on your favorite investing platforms like Robinhood. Use my link in the description to get a free stock. They tend to track an index like the S&P 500 or the DJIA, or an industry like technology, healthcare, or the energy sector. Much like the market itself, you can conservatively expect an 8% annual growth from a good index fund. You might have read all this and are now thinking about buying index funds. That's great to hear. You might now be looking for guidance on what funds to buy. I'd warn you to always do your own research, and none of this is financial advice. It's hard for me to recommend index funds for someone to buy because you're all individuals with different investing timeframes and goals. However, if I were to point you in the right direction, I would say to Google S&P 500 index funds and index funds at your preferred industry. If you think healthcare is the industry to invest your money in, look for healthcare index funds. If you think technology has nowhere to go but up, search for technology index funds. In conclusion, investing takes research and strategy. Buying individual companies without doing appropriate research is speculating. Speculating has a high probability of failure. In my view, dollar cost averaging is the best strategy for long-term investing and wealth creation. Index funds can play a key role in building wealth because they are low risk and follow a market, increasing your likelihood of growing your wealth year over year. Well, that's my video on investing in index funds. I appreciate you watching. Let me know any questions, comments, or topic suggestions you might have on personal finance in the comments below. Be sure to support us on all of our social media platforms. Follow us on YouTube and now on Facebook at Smart Money. Links will be in the description. If you're watching on YouTube, subscribe and hit the notification bell to be the first to know when I come out with new content. Thanks again for all the support in the comment section, and a special thanks to Sierra Boykin, who was our featured comment for this week. Make sure you join the discussion for a chance to have your comment featured. I read and reply to all the comments I get. Make sure you like the video for the algorithm and be sure to share the video with a friend. Check the links in the description for offer information. Lastly, the stock market is set up perfectly to buy stocks at a discount right now. Even if you're just curious and looking to start with $100 or even less, I'd recommend using Robinhood. It's completely free. Plus, if you use my link, you will both get a free stock just for opening an account. It's a win-win. Comment below and let me know what you get. Thanks for watching, and I'll see you in the next video.